So when we kick off with the consumer, we always want to look at what is credit doing? How is revolving credit looking? What are some of the changes? So year-on-year percent growth in revolving credit came in strong in April at plus 13%, off the peak, but still, very fast relative to history and more in line with the averages seen prior to 2000. So again, you're still seeing that consumer credit pressure point. Now, April consumer credit grew 23 billion versus the estimate of 22 billion. And 22.8 billion in the prior month. Heavy revision lower from the 26.5, but it's still the largest increase since November of 2022. So you still get a lot of that's the credit card spending, which is really kind of buffering some of these movements, which again is keeping us cautious when you start looking at what is the consumer doing, how is the consumer interacting with the market in general. Now, when we look at inventories component within ISM services, the PMI spiked in May, rising to one of highest levels in survey's history, which is a dramatic move when you consider the component was deeply in contraction. So again, when you look at some of those inventories, this is why the inventory numbers are, you have to look at multiple things. Was it overstated to the downside earlier? Maybe. Upside? Maybe. But it's important to look at inventories have been replenished, that supply side is gone, so that inflation piece, the stickiness in that price is an underlying problem. So then when you look at the New York Fed survey of consumer expectations, percent saying it is much harder to obtain credit versus a year ago, percent saying it is somewhat harder to obtain credit, you're all of that is moving in the wrong direction. So the survey of consumer expectations revealed tighter credit conditions. Share of respondents saying it's much harder to obtain credit versus a year ago rose to the highest in a decade. And again, that's what they want. That's by design, but that's going to slow things down. That's going to slow the consumer down. And it's near impossible to say when, where, how. We've said the end of March was the peak, and we still stay with that in terms of where we've seen some of the slowdowns, how that's going to continue throughout, especially when you start looking at, per the New York Fed survey of consumer expectations, the one-year inflation expectation has fallen to 4.07, lowest since May, but the three-year expectation moved higher. So everyone's saying, look, inflation is going to come down. That's that's going to happen. The pace is going to be slower than expected, but the long-term issues still remain there, and that's where we continue to see some of these hindrances, some of these problems, which are not going away anytime soon. And that's why when we look at the consumer, when we look at their spending patterns, we see a lot of pressure. Now, on a month-on-month basis, coming to the CPI, came in at 0.1 versus the estimate of 0.1. Core came in at positive 0.4 versus the estimate of 0.4. Worth keeping in mind that last time we saw the 0.1 gain in headline CPI was just a couple months ago in March when the Fed hiked rates. But again, month on month is cumulative. We're seeing a continuous build on pricing, which is why some people out there are jumping for joy that pace has slowed, and the consumer, or at least anyone that buys things, are looking around and saying, why are we excited? That's still way more expensive than it was even 4 months ago, let alone a year ago. So again, but the pace has slowed. Obviously, the rate of change is there. The May CPI year on year came in at 4% versus the estimate of 4.1. But the core came in at 5.3 versus the estimate of 5.2. Again, the pace of core inflation is slowing down, which is why when you look at the consumer, when you look at the pain that they're feeling at this point, that core piece is really highlighting how things are not improving for them. That's why when you look at the impact and why you're getting the impact on real wages, and we'll talk about this in this segment, how wages are coming down. Wages are slowing just as inflation remains elevated. Core goods saw year-on-year rate tick up to positive 2% in May. Conversely, core services saw year-on-year rate move lower to 6.6%. But again, it's going to converge somewhere in the middle. So you have goods going higher again. But then you saw services going lower again slightly. But again, look at where core services is in regards to history. It's still at levels we haven't been at since the early 1980s. This is not a good position to be in when you have wages paring back. CPI core services ex housing fell to 4.6%. Again, that is a nice benefit, but even going back through history, even with the pullback, you're still at very elevated levels. Owner's equivalent rent portion of CPI saw a slight easing in trend, down from 8.1% to 8%. But again, just look at it versus history. And we're getting excited because it's just starting to creep. But again, when you look at it, it's going sideways, and that rate of change, it coming down, is going to be much slower than the rate of change it was going up, keeping those pressure points. Small business optimism index ticked up to 89.4 versus the estimate of 88.5. The prior month was 89. Outlook deteriorated to negative 50%, which is the lowest since December of 2022. New order components within the ISM manufacturing, it has been at negative 50 for 9 consecutive months, which is the longest streak since early mid-2009. So again, optimism is down. General business conditions are the lowest that they've ever been going back to 2000. Obviously, 22 was worse, but again, just look at you're just consolidating at a very weak point, and the new orders continues to show there's no reason for this optimism to have a marked shift higher. As of the first quarter of 23, household net worth as a percentage of disposable income fell to 760%, down from 840%. In year-on-year terms, fastest decline since the fourth quarter of 08. So again, you're seeing that decline, but you're still at a very high level. It's not like you're not at a high level in terms of, interest payments. You're still in this kind of back and forth, but the movements are still coming under pressure. Again, shifting things down, especially when you look at wages. Wage tracker on a non-smooth basis was a big focus for many in April, given the significant decline to 5.1%. But it essentially reversed in May, given the wage growth shot back up. But now wage growth from the Atlanta Fed fell to 6.6% in May, down from 6.1% in the prior month, and the lowest since April of 22. It's still strong. And that's the key piece. It's not that we're saying it's not strong. It's that it's moving in the wrong direction as inflation is, especially core inflation, is remaining elevated because wages are coming down as month on month costs are going up. So costs are going up month on month as wages on a month on month basis is coming down. So again, that's where we see this backdrop in this separation, which is why real wages are creating this struggle point that we continue to see. And this is just looking at the Atlanta Fed a little bit differently. And now breaking it into its pieces, the U.S. median wage growth, the 12-month moving average, when you look at third wave, lowest earners, the lowest earners are coming down. The second wage quartile is coming down. All of that is showing you that the pressure points, those lowest earners that were going up so much, are now coming down as their prices continue to climb. And I don't know if you saw Walmart came out and said that if the stealing continues, they're going to have to raise prices. So you're seeing this continuous pressure point for those two tiers, which again is going to become that bigger and bigger problem. Revolving credit, looking at it slightly differently. Consumer credit owned and securitized is still below, and this is versus disposable income, is still fairly low but rising. And this is looking at it slightly differently. Revolving consumer credit, bouncing up. Real revolving consumer credit still staying at that lower end, but they're closing that gap. And the issue is it's going to close quickly when you look at that rate of change versus where we've been from 16 to 19 versus now, because of the cost of goods, because of the cost of inflation to the consumer, which is having that rapid acceleration to the upside. Personal interest payments continue to jump. That's just based on tightening credit, unwillingness to lend. Again, interest income is going to continue. Interest payments are only going to go up, while interest payments and salary distributions flatlines, again, causing that issue with commercial bank credit card rates. Just looking at commercial bank rates are over 20%, and it's the highest it's ever been, which is, again, why those interest payments and interest income those interest payments are going up, again, creating more of that pressure, which is why spending patterns from the start of the Fed hikes continues to fall. Economic headwinds continue when you look at mall traffic. Again, all of this is showing that the movement is in the wrong direction and that you're seeing that consumer pressure. Now, it takes time. We're not saying it's all at once because monetary policy works with a lag. And that's why there's going to be that hesitancy of cutting rates, because if you cut rates too soon, well, it means that you didn't get to where you wanted to be, and the acceleration, as we've seen, can be exponential, as we saw in the into the 70s, which is not what they want to see. On average, annual growth in spending tends to peak 15 to 18 months after the Fed starts raising rates and slows substantially over the following 15 months, which is why when we talk about the IMF expectations, the World Bank expectations, this is not just a 23 story. This goes into a 24, 25 story, which is why those issues are going to be real. Now, wage growth is fading fastest in the low wage categories, which again maximizes or increases the pain to those consumers. Now, when we look at coming back into the small businesses, where a lot of these people, especially on the lower income scale, would be trying to find work. As of May, inflation crawled back to the single most important problem for small businesses. Not surprising, quality of labor remains the close second. Unemployment rate has now been below 4% for the longest time since the streak that ended in 1970, because there's that labor problem. So which is why labor is such a big part of inflation, and it's difficult to see, again, that reversal without seeing some meaningful adjustments. And labor being such a big part of cost, why we see that stickiness remaining on the inflation front. Small uptick in percent of small businesses raising compensation. Again, not what the Fed wants to see. They want to see compensation coming down because, again, the fear of a wage price spiral is there. It's obviously, they've tried to cool it off, but this is why they need some of that, a bit more unemployment. They need some of this to continue, and the credit condition component within the small business survey continued to deteriorate in May, falling to the worst level since December of 2012. And again, if small businesses can't borrow and they can't get the credit that they need, well, they're either going to not hire or they're going to pay people less, which would cause people to quit, or they are going to have to let people go. And that's what they're trying to do. They're trying to get the credit conditions to worsen to the point that unemployment increases, bringing down labor cost and trying to kind of balance this out because we continue to see those pain points. Household net worth increased by $3.026 trillion in the first quarter of 23, largest increase since the fourth quarter of 21, up from $1.6 trillion gain in prior quarter. So again, you still see that net worth going higher. So this is there's still a lot of this is again tied back to the value of 401ks and the recovery in the underlying equity markets. April wholesale sales came in at 0.2 versus the estimate of 0.9. And again, when you look at the prior, it was revised down from negative 2.1 to negative 2.7. Inventories came in at negative 0.1 versus the estimate of negative 0.2. So again, all of these things still showing those pressures that are signaling the consumer slowing. April business inventories came in at 0.2 versus the estimate of 0.2, slightly below long-term average and out of recessionary territories. But again, you're just looking at this balancing act in terms of where we sit. May industrial production came in at negative 0.2 versus the estimate of 0.1. Factory production came in at 0.1 versus the estimate of 0.9. So again, all of this is showing that trend down, but it's not a collapse. And this is where I think people get lost with. We're not getting this big collapse. We're not getting this easy call of up. Well, obviously Q2 and Q3 are going to be down, 15%. We're not at that point. We're in this massive, contraction in terms of the stagnation. So it's contracting, but in a way where inflation's keeping that problem there, and that growth is just not happening. It's being stifled. And even if you had some miracle of a rate cut, that would not drive growth. There are so many issues out there that can really only be cleaned up by making these tough decisions and keeping rates elevated. Now, the unemployment rate about to rise, so the ratio of job openings, jobs hard to get, is narrowing, which is typically, typically comes to the rise in the unemployment rate. Job openings are getting back to normal. So again, you're starting to see that balancing act, which is what they want to see to try to cool things off. Lowest earning quartile of workers starting to see decisive rolling over in wage growth, though still strong relative to history. Highest earning quartile hasn't seen any slowdown in growth. So again, the highest side, remember, it kind of it was slow to start moving, but that lowest one is rolling over hard, and they're going to be hit the hardest because, as we've talked about, inflation is a big penalty or tax on the lower income workers. Home equity loss. U.S. homeowners with mortgages lost small amount of equity last quarter of 0.7% year on year. Decline was the first since 2012. The drop amounted to an average of $5,400 per borrower. Typical U.S. home buyers down payment was $52,500 in April, which is down 18% from a year earlier, but still high in comparison to history. Median down payment was equal to 13.1% of purchase price, down from 16% a year earlier. So again, but it's not equal, especially when you start looking at homeowners in general. When you look at the average homeowner with mortgage saw a home equity drop, but look at 25,000 and more in terms of the West Coast, the East Coast, and there's again where you see a lot of these pressure points, and that's why again this is going to impact some of that value. MBA U.S. Purchase Index, when you look at mortgages, again, well below normal. We're having that seasonal bounce, but it's the lowest it's been since 2014. On the purchase side, again, seeing something similar in terms of the 2023 level. These are, again, the leading indicators of why we remain concerned about where homes are going and home values are going. Month supply of existing homes continues to be low, but starting to average out, and that'll continue to grind higher as we see more supply and new homes coming online. Rents posted largest drop since 2020, still just slightly negative, but again, we still have to price in all of those increases, which is why when we talk about that core piece of inflation, a lot of that is driven by rent and owner's rent equivalent. Yes, it slowed, but it just went negative, and the lag between the two is close to 8 to 12 months. So again, there's still a lot of that upward side, and rents are falling in the West, rising in other parts. So again, it's kind of a mixed bag, but the trend still continues to be to the downside. Mortgage purchase index remains quite low with year-on-year percent change still deeply negative. Again, just confirming what we've seen. And then it's funny because Powell said he sees housing putting in a bottom and moving up. Well, just look at Zillow home value index and that little dip, which again, if you compare it to wages, which wages are rolling, and now you actually have home prices remaining elevated, again, keeping the massive amount of stress on the consumer and on the underlying valuation, which is why we see home prices continuing to fall. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into Europe and where Europe continues to trend.